Well, as you can tell, we are going to kind of work off each other tonight, so we'll be transitioning between the two of us as the night progresses. One of the things that Sean went over is roughly the fixed side of your income. What I wanted to go over real briefly is some of the variable aspects, so taking from your portfolios, your accounts, and then how that works with Social Security is what we're going to start tying in a little bit later. So the first things that we look for in this respect is just what is your savings? How can we create basically some cash flow from your savings accounts, your retirement accounts, and that's really what we do a lot with on a daily basis. So when we started looking over all of our clients and what has been working for them, we came up with 4 different strategies that have worked very well for a lot of our clients. I just wanted to share with you tonight. The 4 are live off the interest, mandatory versus discretionary, the 4% rule, and then we also have the bucket strategy that we'll be spending a little time on and hashing out a little bit more. First one is the first way that we can work with your assets is living off the interest. Now this is a great strategy. What this one talks about is that we can invest the assets for income. So we take the income off of the assets and that's what you live on. It's really nice because we do not have to touch the principal. We can let that be and we can just use the interest that it gains. The one bad part about this is that it's always fluctuating. It's always based upon what the interest rates are or what you're receiving in dividends from your portfolio. Now we did have to talk with one of our clients about this. She wanted $30,000 extra a year from her portfolio using this method. Now, she was very risk adverse. She did not want to take on a lot of risk, meaning she only wanted about a 3% return at the most because she didn't want to take any more risk with her money. The unfortunate part that I had to talk to her about is that she needed to be a millionaire so that she could take 3% of her portfolio to equal $30,000 a year. So we talked through it, we came up with some strategies, but this is one aspect that works very well for a number of different retirees of how to live off their assets and make sure it lasts. Next one is also very simple to understand, mandatory versus discretionary. The biggest part about this is that we match up where your expenses and your income comes in. So this one works with matching up your fixed income, so that would be your pensions that we talked about, the Social Security that you'd be receiving, and that will be paying for your fixed expenses. So say a mortgage would be a part of that. Healthcare, anything that would be a fixed expense would be taken care of by your fixed income. From there, we can take the additional amount out from your portfolios, which would make up your variable expenses, or in this case, discretionary. So that would be eating out. That would also be entertainment. That would be even, comes down to, say, gas and groceries could be under this as well. So that's another strategy that works well with our clients, is to start matching up their income sources. The third one that I'm sure many of you have heard of throughout the course of just reading the papers and listening to different pundits and people that try to speak authoritatively on the subject, is the 4% rule. Now I'm sure many of you who have heard of this rule probably remember a couple years ago when it was not called the 4% rule. It was probably called the 5% rule or the 6% rule. So like everything, we've had to lower our expectations with the economy and what's been going on the last number of years. What this one states is that we can take 4% from your portfolio on a yearly basis, plus what would be for inflation, what we call it the cost of living adjustment, and that has a very good probability of lasting throughout the entirety of your lifetime in retirement. So those are 3 strategies that we have used with our clients that work very well. The last one I wanted to spend just a little bit of time on because some of you probably have not heard about this strategy in the same way. The bucket strategy is what we call it. This one is very unique because it matches up time frames of when you need the money. And that's different than all of the others because now we can look at your expenses and say how much are we going to need in certain time frames. And what we do from there is make sure that money is absolutely available for that time frame. So giving an example, and we're actually going to be talking through a couple of our calculations we go through with our clients. A quick example is that we look at, say, years 1 to years 5 in retirement, and over the course of that year, or those 5 years, we know exactly how much you'll need to live on. We go through budgets, we go through differences like that, and we can come up with a number for those 5 years. We want to make sure that that money is very safe, very secure. We don't want a lot of market risk. We don't want it to go up and down a lot because we know you're going to need it right now. So those can be invested into CDs, be invested in some municipal bond funds, some bond funds that earn some dividends, things that are going to be pretty safe. From there, we're going to step out to the second time frame, years 6 to years 10 in retirement. You're going to need that soon, so we can't be super aggressive with that money either, but we can be just a little more aggressive than the first bucket that we have, meaning we can get a little bit better interest on it, and then when it comes time that we need to use that money, we'll put it back into the safety bucket, and that's the money will be available to use. So that's strategies that we have worked well with our clients. How this one breaks down is that each bucket we have has what we call its own unique interest rate that we can try to project for that bucket. So when we're actually using it, we want to be very safe, probably a 3 to 4% rate of return, and that would be all that we'll probably get with that bucket. But that way we can have safety first and have it available for you. We can also establish the buckets that are going to be for growth for 5 years out, for 10 years out, for 15 years out. Those are all going to be available at future times. So we can work with you on an individual basis. We can manipulate these numbers to make sure that it's going to be something that's achievable and something that will make sure your money lasts. So those are ways that we work with this. And when we put it all together, we can actually come out with down to the specific number of how much dollars we need in each bucket. So what this shows is that in the first year to the first 5 years, taking $40,000 out of this account a year, we're going to need $200,000 set aside. Very safe, very secure. We don't have to worry about the market. We don't have to worry about the fluctuations that is happening, the ongoings of the stock market in that respect. So this is something that works out very well to have safety. The next bucket is one that we can have set up for a little bit of growth. And so in this case, we needed $175,000 available 6 years from today, meaning if we have a little bit of growth, what our calculations show up here is that we only needed to put $125,000 in today's money in that bucket so that $175,000 would be available in 5 years. So those are types of the strategies that have worked very well with our clients and some that we hope you would consider. So those are all in the packet that you can take a look at. If you have any questions, you can ask us more about that. We did cover some of the pros and cons here with those strategies, but they are listed for you to remember. We've been talking a lot about strategies and how to take from your accounts, but no strategy would be complete without spending a little time talking about taxes. The only thing I want to note from this slide is that each account is going to be taxed at a different, basically a different rate, taxed in a different manner. So Social Security, which we'll be talking about a little later, the tax on that, will be taxed differently than, say, your pension. Your pension may be taxed differently than your retirement accounts, say your IRAs, your Roth IRAs, your 401ks, 403bs. So each of those you need to take into account of how to draw from the money so that you can reduce your taxes and increase the amount of money that you have available for retirement.